Good afternoon, everyone. I'm Madhu Apisa from Al Raji Capital, and I welcome you all to Jamjoom's Q3 2024 earnings conference call. Al Raji Capital is proud to host Jamjoom's Q3 earnings call. As usual, we'll be having a presentation followed by a Q&A session at the end. From the management, we have Dr. Tariq, the CEO, Mr. Anwar, the CFO, and Mr. Mohammed bin Khalid, Associate Director, Finance and IR. Without any further delay, I'll hand over the mic to Mohammed to introduce the management team and start the proceedings.
Assalamu alaikum, and thank you everyone for joining us for our third quarter earnings call. We're pleased to have you here, and I'm joined by Mr. Anwar Mohyuddin, the CFO, and Dr. Tariq Yusuf Husni, the CEO of the company. We'll be having a 20-minute presentation in which we will discuss the financial and operational performance of this quarter, as well as the 9 months of 2024, followed by a 40-minute session for Q&As to answer all your questions. With that, I'll hand over to Dr. Tariq to take us through the presentation.
Thank you, Muhammad, and everyone, and I welcome you again to yet another strong earning quarter for Jamjoom Pharma. I'll be pleased to share with you the slides as usual. We'll focus on the business key deliverables, execution on strategy, and then I will share with you some comparisons as always as well. We'll share the financial analysis as well, and then we'll share with you an update slide on the guidance, and we'll take the questions later on. With this, Muhammad, if you can move to first slide, please. All right. So as you can see here, this is an update on the year-to-date performance. As always, the revenue is we are at a very strong 1059. That was, by the way, almost like the whole budget for 2023. So we achieved this in 9 months, and we even did better on the net profit than the whole year on a higher number in 2023, because we ended up in 23 achieving 1102 and 292 on the net profit. Today we track at 1059, as you can see on the top line, and a better net profit than what has achieved the whole year last year on a higher sales number, 305. So very proud of the team performance at all levels, quite honestly, between commercial, manufacturing, finance, and everyone who contributed to date. Our EBITDA is tracking at a very strong 26 year-on-year growth at 365. Free cash conversion is showing the same percentage growth year-on-year, 26%. And we maintained CapEx as per our guidance at even the lower end of the guidance at 4.4%. Managed to launch, we always said that we'll target launching 6 to 9 products. We launched on the pharma side almost 5, maybe another 2 or 3, and 4 on the consumer side. I'm pleased that out of the 5 we launched on the pharmaceutical side, 2 of them comes in type 2 diabetic, which bring the total number we launched so far between 23 and 24 of type 2 oral anti-diabetic agents up to 4 products. As I said, our net profit is tracking at 305 million with 23% growth year-on-year, and earning per share of 4.4. Production did 23% year-on-year as well, and we track at 130 million unit produced year-to-date. Next slide, Muhammad. So basically, I will show you as always some key highlights from our key active markets and key functions as well. What are we doing to execute on the strategy? We always said that we'll try to do better in Saudi Arabia in the tender and the institution, because we are coming from a low base there, so we can always grow at a higher level without diluting our earnings, and that's exactly what we are doing year to date. As you can see, we are growing 41% year to date on our tender sales. while the total Saudi business is growing at 17%. So far much higher pace on the tender, and still while delivering some of our best percentage financials on both EBITDA and earnings per share, which shows that we are really excelling in executing on the strategy. The total market in Saudi has grown at 16%. That's up to end of August. Out of the type 2 diabetic injectable products from Eli Lilly, the market has grown at 11.5. So you can argue almost 1/3 of the total market growth is contributed to by one product from one company, which is taking the market by surprise, as we discussed before. In our other export markets outside Saudi Arabia, we are growing significantly, as I'm going to show you in the coming slide in our key markets. Egypt is tracking very well and continue to show very strong performance on the value side, growing at 37%. On the unit side, growing at double this figure, almost at 63-64%. Portfolio point of view, we are really progressing in our cardiometabolic, gaining 13% growth year on year, still coming from a low base, mind you. So we are managing our expectation well, but it's a good start, if I may say. Our new products are tracking very well based on year-to-date targets and tracking above targets. So our new launches are really ticking the box on a green front when it comes how it's tracking versus budgets. Manufacturing, our Jeddah facility, the main one, is, as I always shared with you, it's almost working hand to mouth, operating at a 97% utilization rate. The new trial facility has produced year-to-date 2.6 million, and Egypt continue really to track well, and the manufacturing facility there is now contributing into between 60 to 70% of the month-on-month sales of the local operation in Egypt. And we aspire that once we transfer our new products registration there, the existing portfolio, then we are going to have the Egyptian facility contributing to up to 90% of the local operation requirement in Egypt. Still, we're working, as I previewed you last time, on some key initiatives when it comes to business development for adjacent categories. We're looking at biotechs or biosimilars. We're looking at adjacent categories. How can we strengthen our cardiometabolic portfolio to make Jamjoom Pharma a leader at this front, plus some other key therapy areas that we are tackling. But definitely we'll continue to update you once we sign deals and finalize such initiatives. Next slide, Muhammad. That's a refreshed update on the every plant of our 4 facility today, how it's tracking. So in the Saudi main Jeddah facility, we believe that we'll get the capacity up to 150 or beyond. And year to date, we have managed to get 109 million out of this facility. The new trial facility, as I told you, produced 2.6 million, but still early days because we didn't get the full license for all the products that are going to come out of this facility registered to commercialize. You know, we need 2 licenses for this plant. One for the whole plant, which we already got from Saudi FDA. So this plant is fully operational, but we still have to have every product moving from the other facility into this facility to be having a license to commercialize out of the new facility. And we're doing this gradually as we speak, and we believe we'll finish all these products transfer by end of first quarter 25, beginning of second quarter 2025. In Egypt, as I told you, we are tracking today at 60% of the requirements of the operation there satisfied by the local facility. We track at 18 million units produced year to date, and we believe that will close the year at something close to 25 million units, which will be almost at 50% of the capacity utilization based on the theoretical capacity that we assume for this plant, which is 52 million. In Algiers, in our JV, we're tracking well. we have produced year to date 8.2 million. But all these products, if I refresh your memory, are us manufacturing for a third party, which happened to be Novartis in this case. The formal owner of the plant. We're manufacturing their established and tail products against a fee there, and this contribute to majority of our production in this plant. Next slide, please. Yeah, so that's a good summary slide that can show you the performance split into, on the left-hand side, every therapy area, the growth. On the right-hand side, on the top, every market, how it's contributing to the growth. And then on the bottom right-hand side, the key areas that contributed to this growth. So if I start on the left-hand side, basically we have grown year on year on the first 9 months, 19% or 18.7 to be more accurate. As you can see, every therapy area contributed very positively. Ophthalmology, dermatology at close to 20 and 21%. Every other therapy area have really contributed very strong. Anti-diabetics obviously doubling, but it's coming from a low base and different timing as well, because we didn't have a full year sales last year in Saudi. By country, I'm very pleased with the contribution this year, because as we speak at the moment, we closed the first 9 months at every market above 100% achievement, tracking to the target set and contributing very strongly to the growth. Saudi, as our most close to mature market, growing at a significant 17%. Gulf, 19%. Iraq, another 17%. North Africa, 21%. And then Egypt, as I told you earlier, 37% in value growth, 64% in unit growth. If I look at what contributed in terms of itemized area to this 19%, you can see that it's almost 80% coming from growing the existing portfolio that we carried forward from 2023 into 2024. And the remainder of 20% are almost split between coming from new brands and coming from price increase. So almost 15% of the 19% growth coming from growing the existing portfolio, and the other 4% are almost 2.5 from price increase and 1.5% from the new products. Moving forward, Muhammad. Yeah, that's a slide that I keep on updating for you every month. Very proud, and we'll continue updating it with you. Basically, to refresh your memory, this is a slide that shows you from January 2022 up to August 2024, every small line for each one of the 5 competitors here, including Jamjoom Pharma. In the middle represent a month, and every red reflects that this particular months have declined versus its equivalent months in the prior year, and every green reflects that this particular months have grown above its equivalent months over the prior year. So as you can see, while Jamjoom Pharma in over 32 months has only one red dot in its 32 months, which means only 1 month we showed the decline compared to its prior equivalent months in the previous year. All other companies are tracking between 6 to 11, almost negative, which shows something I'm really proud of, and I always shared with you, which is not only the deliverables of Jamjoom Pharma team quarter by quarter or year on year, but the consistency of our performance when we track it against our key peers as well, or the top 5 players in the retail market in Saudi. On the bottom right-hand side, you can see that year on year, Jamjoom Pharma, compared to the market growth, have outpaced the market growth and really added share year on year. And mind you, the share we are reflecting in 2024 here is without the impact or taking off the impact of the injectable type 2 anti-diabetic product that is contributing 1/3 of the market growth. If we remove this out of the equation, then our market share will be above 6%. It will be basically 6.15% share. Something we're really proud of, and we keep on really tracking well against all the criteria we set for ourselves as performance indicators. Next slide. So this is just a quick pipeline overview, whereby basically it shows you that our pipeline on all the therapy area on the left-hand side is basically split 50-50 between products that are already submitted to Saudi FDA and waiting approval or about to be submitted, and the other 50% is under development. So a good inventory, and hopefully we can push the submitted products to get quick registration to achieve speed to market, and we can as well accelerate the under development one to push it to replace the ready for submission. At the same time, as I shared with you earlier, we're looking at actively at adjacent categories to contribute to first complementing the existing therapy areas with other agents, or to get us into adjacent categories that are going to be complementing and strong driver for our business growth going forward, like biotech products and some other areas in cardiometabolic and other therapy area. Next slide. So here is a slide I always share with you as well, quarter by quarter, which shows how we are transitioning the business between 21 into the first 9 months of 24. And you can see in 2021, we had ophthalmology and dermatology, which are our key two therapy area, contributing almost to 55% of the business. Today, while as I shared with you earlier, and it's mentioned here at the bottom of the slide, both these two therapy areas are growing at a very phenomenal 21 and 19% respectively. Still, we grow majority of the other business at a higher pace. Hence, the contribution of ophthalmology and dermatology are getting less, and we are diversifying in a more healthier way our business through better contribution from metabolic, from consumer health, from general medicine, and hence and forth. So I'm very pleased as well with this transition. While we are strengthening our leadership in ophthalmology and dermatology, we are as well growing our business everywhere else at a higher pace, so that we diversify the portfolio in a healthier manner. Next slide. With this, I will hand over to Anwar, our CFO. He will take you through our key financial highlights, and then we'll go back to discuss the guidance and any question in your mind. Anwar?
Thank you, Dr. Tariq. And good afternoon, everyone, and thank you for joining us today for our earnings call. Mohammed, next slide. I am pleased to share that our performance in Q3 2024 has demonstrated continued growth across all financial metrics. Our revenue increased by 12% year-on-year to Saudi Riyal 328 million, driven by strong demand across key therapeutic areas, as well as new product launches. This reflects our broader trend for the first 9 months of 2024, where we have achieved an overall revenue growth of 18.7%, reaching revenue over Saudi Riyal 1 billion. EBITDA is also grew significantly by 23% year-on-year to Saudi Riyal 112 million in Q3, underscoring our focus on cost control and efficiency improvement. This led to an EBITDA margin of 34.5%, in line with our performance in 9 months 2024. Net profit increased by 23% year-on-year to Saudi Riyal 95 million, showcasing a consistent net profit margin of 29%, which remains above market expectation and reflect our continued profitability across all our key markets. Additionally, our free cash flow saw significant growth, increasing by 38% year-on-year to Saudi Riyal 101 million, driven by disciplined cash management and a focus on generating liquidity to support growth. On the next slide, we will discuss our production cost and operating expenses and how we address cost inflation to preserve our margin. Turning to our cost management efforts, we have effectively navigated rising cost, particularly in our cost revenue, which rose by 29% year-on-year. This was mainly driven by increased raw material prices, changes in product mix, and higher supply chain cost. However, we managed to contain operating expenses, which increased by only 6% year-on-year, highlighting our continued focus on efficiency. Our material expenses increased by 30% year-on-year, due to production ramp up across our facilities, while salaries and employees-related costs rose by 28% year-on-year due to increased manpower for our new facilities. Despite this cost pressure, our effective cost control have helped mitigate their impact. Our direct production cost per unit increased slightly to 3.1 Saudi Riyal year-on-year for 9 months 2024, but remained significantly lower compared to the year 2022. Moving on to the next slide, we focus on our margin. Moving towards for profitability, I am pleased to report that our EBITDA margin expanded to 34.5% in 9 months 2024, representing a 2 percentage base point improvement from last year. This improvement was achieved despite rising cost, thanks to operational efficiencies and improved sales efforts. As shown on the right side of this slide, our EBITDA and net profit margin have remained strong throughout 2024, positioning us an industry leader in profitability. Notably, our EBITDA growth outpaced revenue growth, expanding by 26% year-on-year in 9 months 2024. This performance is supported by strategic efforts in cost control, economies of scale, and portfolio optimization across all our key markets, in addition to meaningful contribution from our joint venture in Algeria. We will now move on to cash conversion cycle on the next slide. Lastly, our focus on cash flow efficiencies continues to support our strategic growth. Our cash conversion cycle increased slightly by 5% to 282 days, reflecting our strategy to build inventory reserves and manage our receivables and payables due to business expansion. Working capital grew by 11% year-on-year to 683 million, in line with our revenue growth, and we maintain a strong free cash conversion rate of 87%. We have also increased our inventory level of raw material in order to meet future supply challenges. Despite this investment, we ended the period with net cash position of Saudi riyal 119 million, reflecting the strong liquidity position of the company. This performance highlights our ability to balance growth with financial prudence, enabling us to continue supporting future expansion, particularly in high potential markets outside KSA, such as Gulf, Iraq, and Egypt. With this, I would like to hand over to Dr. Tariq for the future outlook and guidance.
So thank you, Anwar. So moving into next slide. So basically, we shared with you last quarter that we upgraded our guidance for the top line to 15 to 18%. Today we track at 18.7, so very close. EBITDA margin, we are tracking in a positive manner compared to the target we shared with you. And on capex, as I said, we track at the lower end of the range we gave, which is 4 to 6%. We track at 4 to 4% of capex percentage out of top line. And we'll basically take the opportunity to as well reassure our guidance for 25 and 26, because if you remember, since going public, I already shared with you an outlook for a longer term plan than just year on year. And we said that up to 2026, we commit to grow the business at 12-15% top line, and we are reassuring this. The EBITDA margin to track at 30 was an opportunity to 100 to 150 percentage point boosting. Capex 4 to 6% of top line, and we remain committed as well, though the story is a growth story, but we are as well complementing it with very strong dividend distribution on biannual basis at between 50 to 60%. We did the first half dividend of Saudi Riyal 1.6 per share, and this time as well we'll do the 50 to 60% payout ratio in the coming few weeks. At the end of after the end of 2024, inshallah. So with this, I will stop here and will invite any question from your side.
Thank you, Dr. Tariq and Mr. Anwar, for the insights. We open the floor for the Q&A session. Before we start, a few instructions. Please limit yourself to 2 questions, and you can ask your question by clicking on the hand raise button or use the chat box. First question is from the line of Ibrahim. Ibrahim, please unmute yourself and go ahead.
Ibrahim Atiyah from Ashmore Investment. Congrats, Jamjoom Management, for those great results. First question comes to KSA revenue. So if you can help me understand this, you achieved 24% sales growth in private market KSA. And you've mentioned you've achieved as well 41% growth in tender market on a trailing 12-month basis. This resulted in only 17% growth in recognized sales from KSA. So what caused this discrepancy? Is this
I'm sorry,
an
where did you
implied
get
increase in discount?
Where did you get the 24% in the retail market from?
This is what you are showing in the slides where you showed the monthly sales growth for Jamjoom and the peers.
We didn't show. Did we show, Muhammad? Did we show that we are growing the retail market at 24%?
Yeah, so this is the IQVIA number.
This is equivalent market number. It's nothing to do with
This is gross sales. Gross sales.
Sorry. No, this is so you're mixing between our actual reported data from Jamjoom Pharma and the IQVIA. IQVIA is different. Here I'm showing you year to date that based on IQVIA, it's showing that we are growing at 24.1% in total retail market. But that's as I always said, that's 70-80% accurate normally, because it has some discounts associated, it has some free goods associated, as you mentioned, it has some other things that skew the data. But that's applied on the total market and applied on us as well.
Yeah. So, Dr. Tariq, if we take the trailing 12 month for KSA revenue, it grew by 15% only, right? This is the net revenue. Your gross revenue in private market grew by 24% and tender by 41%. So is this discrepancy or the variance implies higher discount you're providing?
Again, you're not comparing like with like, you're comparing different things. 41% is our actual gross, our actual internal data. This is the numbers we report to you. You cannot, I cannot compare the IQVIA data with our actual data. These are two different reporting and two different measures. You cannot compare this together. IQVIA data, the market statistics data is just a guideline for us, but its percentage accuracy, as I said, it's 70, sometimes 70, sometimes 80, more or less, because it has some other elements. So you cannot compare our internal data, the one I'm sharing with you, with IQVIA. These are different things.
Okay, great, thank you.
This
question in regards
why we use IQVIA, because that might be in your mind, Akhi Ibrahim. Why do we share IQVIA with you if it's not as accurate as 100% or close? That might be a question in your mind and other mind, because this is the only benchmark that I can show you us against others. Because in our internal actual data, I can only compare Jamjoom Pharma and how it tracked this year versus last year and versus budgets. But I cannot compare against peers. The only comparison against peers is this one, that I have to take the market statistics agency and then I show you how they are tracking us and how they are tracking the competition. That's why we're sharing this data with you.
Yes, this is very
And
clear, and we are thankful for this.
Number, the actual reported number for Saudi private sales is 15%. And 41% for tender. So that brings you to the 17% Saudi growth.
Exactly, yes.
Great,
So go ahead.
Thank you, and we are thankful for sharing this information. Yes, please go.
Thank you.
So should I go to the second question?
Yes, please.
Okay, great. You've mentioned in the press release that research and development expenses declined by 5% year on year. This reduction is mainly driven by strategic shift in our R&D focus, driven by identifying and capitalizing on growth opportunity in high quality product launches. So cost of exhibit batches and supplies, consumables. So the question here, have you started during this quarter to capitalize R&D expenses, or you've been doing this before? And if so, where should we see it in your financials? Is it in the addition to intangible or addition to PPE?
Anwar, would you like to take this question?
We are not capitalizing. We are charging it to the P&L, and it is part of G&A expenses.
So the reduction is not due to capitalization.
No.
these expenses?
No. Direction is
No,
not
it's actual. We are reporting actual. So it's a true reduction like we are doing with everything else, Akhi Ibrahim, whereby we are not, so when it comes to R&D, we are focusing on less number of projects, but higher quality, as you said, strategically. And we are addressing as well how much the exhibit batches will cost us, how much the getting the material will cost us. And we're giving saving targets to people. So we're doing more with less, basically, and we're focusing on less number of products.
And if you see our financial, we are in separate line, we are showing as research and development expenses. So this reduction, which you are seeing it as operational efficiencies and focusing on strategic products where we are reducing our overall R&D expenses.
Very clear. Thank you, gentlemen. I'll go back in the queue.
Thank you, Ibrahim. Next question is from the line of Usman.
I just have two questions. One is in the third quarter revenue growth of your core therapeutic area, which is ophthalmology and dermatology. We saw strong growth in the first and second quarter, around 25 and 30% for both of the therapeutic areas. But in third quarter, both of these therapeutic areas witnessed a slow growth, like 6 and 4% respectively. So I just wanted to understand, has there been any reason for that? And second question is a profitability in Algerian operations. So that company was contributing around 2 million per quarter in first and second quarter. And then I think it reported as 7 million this quarter. So is there any one-off, or that is a sustainable number that we can focus on? Thank you.
Sure. So your first question is about ophthalmology and dermatology. And you're saying that we grew earlier at 29 and 30, and now at 21 and 19. This is just a quarter to quarter moves, and you need to take many factors as well into equation. How did the same quarter last year tracked? How our in-market is tracking, because you remember, Akhi Osman, I always remind everyone that the shipments is just a final product of us shipping goods from our plant into our distributor warehouses, and this is where we record the sales. But the in-market sales can be tracking slightly different, and the growth there can be tracking differently. Because here we're just ensuring that we have the stocks available to sell in the in-market. So you cannot really draw a conclusion to say because they are growing today at 21 and 19%, then we are slowing down the growth. No, on the contrary, because you have to take into account how much the equivalent quarter of last year performed, and how did it perform over the same quarter in the prior year, and how strong it was. So you have to take all this into account in order to make the fair comparison. Your second question is about the Algerian contribution. Anwar, would you like to take this earlier on, and then I will comment as well?
Yes, actually, Algerian start their production very late in May. I believe May and June they start production, and then they start selling. So that is the reason that, okay, you don't find that revenue. But after that, okay, you are seeing this revenue, and it is not one-off, it will be continuous, so it depends upon the revenue in each quarter. But the reason that, okay, you don't find it in the first half, because the production was late in Algeria.
The only difference, Akhi Osman, as well in Algeria, that is a different situation that we are in compared to our other facilities, is the fact that majority of what we get revenue for here and margin for are products that we are producing for a third party, and we are here liable to them supplying us with the raw materials, so that we are in a position to produce, and so it's not all in our control, relatively speaking, like in other facilities. But we would like to, as Anwar mentioned, it was early days, the first quarter specifically this year, because we only concluded the deal, as you remember, in August, September last year. So it was early days, the first quarter, and we saw some hiccups and some issues in receiving materials so that we are in a place to produce. We believe that today we stabilize the organization so that at least you see such impact and hopefully we can grow it a little bit as well. But it's not all in our control, like in relatively speaking, like on our other facilities. But we'll try to make it as feasible as possible for us to sustain such contribution.
All right. Thank you very much.
Sure.
Thank you, Usman. Just a reminder to the participants, if they have a question, they can use the hand raise button or use the chat box to ask the question. Okay, before we have our next question, we can allow we can take a follow from Ibrahim as he had a few more questions. Ibrahim, you can go ahead.
Yes, thank you. Follow-up question on the margin overall. First question comes to the guidance. Your EBITDA margin includes the share of profit from the JV. Is this correct?
Yes.
So how much you're penciling in terms of margin expansion coming from the JV versus the core business or the original business that you're having?
In the grand scheme of things, a small contribution to our total. That's what I can say, Ibrahim, in the grand scheme of things. But we are hoping that it can grow at the same pace that we are growing everything else. But it will remain for the coming few years, in the grand scheme of things, a very small portion of to contribute to our total margin. Remember, we are only operating today with one manufacturing facility or one line of manufacturing facility, which is oral dosage form or oral solid form. We are into the process of investing into building an ophthalmic unit and dermatological unit that will come in at least 2 to 3 years from now. Once we complete our lines of production, then you will see perhaps a different improvement in terms of the margin this organization contribute to our total margin. But today we are only having a sub of this total contributing. So it's still very small. Don't forget, and I remind everyone, Algeria and Egypt are there to contribute to the longevity of our growth, not to the short and medium term. So we keep on fueling these two organizations so that they are ready to contribute in few years' time into in a more significant way into our growth, both on top in the case of Egypt and bottom line in the case of both of them as well. But today it's still very small.
Second part of the question is the GP margin, which has been on contraction trend for the fourth quarter. And I understand there have been so many questions about this in the last earnings calls, but has there been any recent development in this quarter in particular? Because, sorry?
In what? Any
GP margin, gross profit margin, that caused acceleration in GP margin contraction?
Okay, Anwar, would you like to take this question and then I will comment?
Yeah, it is, product mix, geographic mix. Now, sometime, little bit increase in let's suppose Egypt sales where the margins are less. Maybe in this quarter, the tenders, deliveries are more, tender sales are more. That also contribute to this contraction of the margin. So it is nothing too special. Yes, as we explained that, okay, there is little bit increase in our supply chain cost, material cost that because of this supply challenge is something, but we are managing it very efficiently. So nothing is particular about.
So the way we look at our gross profit margin is on annual basis rather than because from quarter to quarter things can fluctuate. But we set ourselves a target for the full year, and hopefully we stand at meeting or exceeding this target at the end of the year as part of our KPIs. But in some quarters, to Anwar's point, when you see that the product mix this quarter was not the most preferred mix for us, or there was more tendered compared to retail sales and whatever, we manage other elements of the P&L so that we continue to track in a very lucrative manner compared to our final target. Hence, you see that where our EBITDA is tracking today and where our net margin is tracking. But gross margin is a final product on quarter by quarter basis to your mix of markets and products that you sell.
Excellent. Thank you. Thank you, gentlemen. And congrats again on the results.
Thank you. Thank you. Other questions?
Yeah, next question is from the line of Maha. Maha, please unmute yourself and go ahead.
Drug. So it grew by 50%. Is that related to any weight loss drug? My second question, since most of the growth came from weight
Sorry,
loss
I didn't
drugs,
hear. I lost you in the first few seconds of the first question. I only heard it grew by 50%, but I don't know what are you referring to that grew at 50%.
Okay, anti-diabetic drugs. So weight loss drugs go under that area. So did that growth came from a weight loss drug? And my second question, is there a possibility for you to enter that category since most of the market growth came from that?
Okay. So what I showed you earlier on when we discussed the therapy area by therapy area growth, I showed you that our anti-diabetic has grown year on year on more than 100%, so doubled its sales, but coming from a low base. This anti-diabetic that we have at the moment are all oral, and they don't address the weight loss. Yeah, as you can see here, we mentioned anti-diabetic has grown by 110%. Coming from a low base because we're not comparing like with like here because we didn't have them for the total period or most of the products we launched last year. They were not there for the total period of the initial 9 months. But when I mentioned the other thing, which is the weight loss product that contribute out of the total market, not only our business, but the total Saudi market in the retail front by almost 1/3. These are products that we don't have it in our portfolio today. And to your latter part of the question, we don't expect to have it before the year 2029 or 2030 when the patency expires, unless we find other creative way to have it, which at the moment I cannot give you any comment or commitment because we don't have anything on our radar screen that can bring a product like this earlier on our portfolio. But we keep on looking at ways to complement our anti-diabetic portfolios with stronger products, either on the weight loss front or other fronts.
Clear, thank you.
Sure. Other questions?
Ahmed, could you unmute yourself? Ahmed, we are unable to hear you. Ahmed, can you please check your mic? We're still unable to hear you. You can use the chat box if there is any issue with your mic.
I think we can take a couple of questions from the chat box, Madhu.
Yeah, sure. Yeah, there is one question related to Egypt. Why was there a drop in revenues from Egypt, drop of about 9% in Q3? That is question number one. Second is about the raw material cost increase. It grew by 30%. So what was the major reason for such increase in raw material cost? These are the two questions, and there are more questions which I'll read out later.
Okay, so the earlier part, I guess the drop is again quarter to quarter, and as I mentioned, we don't really track this sales in key markets quarter to quarter, especially when it comes to the shipments, because it can have many elements. Like, for example, let me focus on Egypt. We have a very key product that is Egypt specific. We don't sell this product in other markets. It's called Momenta. It's a product on the dermatological line that we don't sell it in other markets except Egypt at the moment. And we were supposed to supply a significant amount or volume of this product at the end of or before the end of September, and for some issues related to getting approval for such a release, we were delayed in such a release. So that impacted our sales in this month, in September, and impacted the quarter. But I think what I need you to remember is that year to date, we are tracking in Egypt at above 100% budget achievements, 36 or 37% growth year on year in value, and more than 60% growth in volume or units sold. That's what we track, and we know that we are moving on the right track. If we lose sales in a given month, we compensate it in the following months, especially if it's like this particular case I mentioned, which is we had the product ready, but we didn't get the approval from authorities before the end of September. But hopefully, the sales will take place in October and will compensate. So this is on the Egypt front. I guess the other question, which is related to the raw material 30%, is not related to Egypt, but the total company. I think it's from the slide that Anwar presented.
Yes, yes, doctor. Yes.
Yeah. You go ahead and comment, and then I will comment as well.
Yeah, actually, that okay. It is not that okay. It also depends upon product mix. As we explained, that took some time to in the quarter you are comparing it. Different products were there. Tenders supply was not that much, and here. So yes, there is slightly increase in the raw material. That few of the material we face some challenges through some airlift or something because of supply disruption in the Red Sea. But again, we are also procuring strategic products, raw material in advance. But that's why you see that okay, we are building the inventory. So we are managing it. We are quite aware that okay, there are challenges, but we are efficiently managing the cost. So that okay, our GP margin will not disturb. Onward.
Yeah, so it's everything that Anwar mentioned. Plus, I will need you guys to remember as well, because this will be an ongoing discussion that we will have from now on, hopefully. And every time you see something like this, it means that we are successful in our strategy, as long as the top line is growing healthy and the bottom line. Because the raw materials is a function of what products are you focusing on and you are selling. Don't forget, anti-diabetics, as I mentioned, are products that are relatively high in price of sales, relatively high in acquiring the raw materials. And last year, we didn't have them for the full year, as I mentioned. We had them, or the two products, we had them only for 6 to 8 months. This year, we're tracking at so far a full continuous 9 months, including purchases that we made to carry us forward until the end of the year as well, out of such strategic product. So as we move on more and more into these relatively higher prices and higher cost products, but hopefully better contribution to the margin, like the anti-diabetics, if we move into other adjacent areas that I mentioned to you as well, you will always see this growth. But it's actually done by design, as opposed to happening to us accidentally, because the more you move into this kind of product, the more you will find that you are growing your raw material at a higher rate. But for me, it's all positive, as long as I repeat again, you see that the total P&L is managed in a very good way, and the EBITDA is increasing at its highest almost since we started to operate, and the net margin is tracking very well.
There is one another question which is related to the raw material increase, which is if the raw material cost has gone up so much, is there a case for you to apply for price hikes?
So we keep, it's not, as I said, I think I'm glad I anticipated this because I hopefully answered this in part in my last answer because that's already included, this increase is already included in some of the anti-diabetic products that we got already from the Saudi FDA, and we got them for a relatively good and high price. And in one of the cases where we didn't have the right price, we went and appealed again, and we got a higher price. So we track well in this regard. And as I mentioned last year, and this year as well earlier, the majority of the price increases that we had it last year, and we were tracking at a catching up basis. So all the low-hanging fruits have been reaped. Price increases will continue to happen to us, hopefully, and it will offset any price reduction. Like I showed you, this year, out of the 19% year-to-date growth, 2.5% or so out of this 19% is coming from price increases, which is good, but it's not as high as the 10% contribution last year of the price increase in our Saudi market and the total 5% for the total business that we got. So as I said, we'll continue to witness and we continue to push the envelope and ask for price increases, either in Saudi or significantly in Egypt, where we are catching up with devaluation as well. But it will not happen in one time, as I will always explain to you, but the government will manage it gradually there on cycle of price increases and other places as well. So we'll continue to get this, hopefully, and in a manner that can offset any price reduction, as I mentioned. But the 10% you saw last year will never happen again out of Saudi business, because we already reaped all the low-hanging fruits, and whatever remains is one product here, one product there, that will keep on pushing the envelope with.
Clear. We have one more question which is related to cost and margin.
Yeah.
This is about the sales of diabetic drugs. Let's assume it continues to increase. Would that create any pressure on your margins?
On the contrary, as I just mentioned, these products come at a good, relatively speaking, high price that we sell at, and relatively speaking, one of our best margins. So on the contrary, the more we sell into anti-diabetics, the more we'll. That's why we are aiming to be a significant leader in cardiometabolic over the coming 3 to 5 years. We will not have this strategic aim if these products will be margin dilutive. That will not be a good business for us to plan for this, quite honestly. I thought that the question might be about increasing our sales in tender and institution, which is already answered for, because as we showed you, we grew our tender and institution business in Saudi, which is more than 50% of our total business, by 41% year to date, and still we are presenting these awesome percentages on both EBITDA and net margin and gross margin still. So we're managing this quite well as we speak.
Sure. Now we'll move back to the hand raise option. I could see Emma's hand being raised. Could you unmute yourself and try again, Emma?
So I think Ahmed has shared a question with me privately on the chat, in which he's
Okay.
mentioning that, so I'll read it out. He's asking that despite a 12% increase in top line quarter over quarter of last year in revenue, the company has seen a 4% drop in OPEX in the third quarter of 24. How does this trend continue into the future?
4% in decline on OPEX versus the 12% increase quarter on quarter.
Yes.
Yeah, I mean, as I said, we certainly, I assure you guys, we don't look at our business quarter by quarter. We don't track our business quarter by quarter, because anything can happen. Like, for example, one quarter, I'll tell you some of the, so that you are with me in the same line of thinking. Our OPEX is a subject of many key areas that we track OPEX against. One of it is our sales and marketing expense that contribute significantly to our total OPEX. And this can see fluctuation from one quarter to another. Like part of what we do in sales and marketing, sometimes we sponsor physicians into key international symposia that will maximize their learning and reflect positively on them helping their patients by directly or indirectly prescribing the right products, and hopefully our products will be part of this. So some sponsorship can happen in a quarter more than the other, or an expense moved from one quarter to another, or even the expense has taken place in the quarter you are mentioning, but we didn't get the bills yet. So we'll get it later on in the following quarter. So this is how we track on the business. We don't really look at it month by month and quarter by quarter. Anwar, would you like to add anything?
Yeah, you already explained. Yeah, so this is by quarter. We don't look into this, as Dr. Tariq said that okay, sometimes we spend high expenses in selling marketing, but going forward it is annualized by the end of the year. However, that okay. On the other hand, we are also putting all efforts to manage our efficiencies. So we are bringing the efficiencies into different part of our OPEX. So that is also continually we are doing it.
Next question. You'll be taking line. Could you unmute yourself? Asmar, we are unable to hear you. Still unable to hear you. Yeah, now we can. Please go ahead.
Yes, I'm asking, could you just reiterate your plans for the Egypt facility in terms of how do you expect its capacity utilization to ramp up over the next year or so? And also, what are your plans of exports to other markets from the Egypt facility? Thank you.
Yeah, sure. So Egypt, as I said, will close this year or will finish the year at something close to 25 million, give or take, north or south of this. And this will constitute almost 60+% of the local organization needs. Not because we cannot ramp the production on a higher pace, but because of how gradual we can move the one product after the other, getting the certification from local authority, from this product being certified as imported to now being certified to be locally produced. So it takes time. As I said, next year, I expect Egypt to contribute before the end of the year to almost 90% of our local needs of the Saudi organization needs, which will basically be, give or take, taking its capacity utilization into the 70 to 80%. Hopefully, we'll have as well some plans getting materialized, or at least getting more clarity about export to neighboring markets, as I always shared with you, the likes of Sudan, the likes of Libya, the likes of Ethiopia, and others, which I cannot affirm today because this is subject to us submitting for regulatory approvals and the authorities, local authorities, approving that they get their supply of the Egyptian plant as opposed to of the Saudi plant. But definitely the plans are there. And hopefully we'll do this gradual as well. Not all markets will give us approval at one given time or at the same time to send the products from the Egyptian facility into the markets, but it will happen gradually, one market after the other. So we expect that in 2026, we are going to get the Egyptian plant capacity utilization up to the 85 or 90%, satisfying both the local organization in addition to the export needs for certain adjacent markets. And we are working from today. Don't forget, I mean, the theoretical capacity that we know today of the Egyptian plant is 52 million. But this 52 million perhaps is based, let me give you an example, on one shift or 1.5 shifts. We can push this always to 2 shifts or more, which will yield us more unit capacity. Some upgrading of certain machinery, for example, can give us some boosting, as we did exactly in the facility in existing main facility in Saudi. So I expect that with very little tweaking here and there, addressing efficiency and effectiveness as well, this 52 that you see today on paper, we can take it up to the 60s and the 70s or beyond, which will hopefully satisfy both our requirements on a local basis in Egypt, as well as the key export markets that we are going to export to out of Egypt. So this will take us into year 2027, year 2028.
Clear.
Thank you. Can I ask a follow-up question?
Yeah, please.
So just want to ask, are you currently facing any challenges in terms of raw material imports into Egypt? And how is your Saudi business supporting any forex requirement of the Egypt facility?
Right. So we stopped supporting Egypt from Saudi, and I hope this will continue to be the case, because now there is far much better availability of hard currency on the local front, so that we can get and we can use for purchases. I mean, the only challenge to put you in the picture with us that I'm facing today with getting raw materials is not the scarcity of getting it or whatever, but it's the cost I'm getting it at. Because don't forget, every product we are moving into getting local produced in Egypt, I have to spend at least a year up to 18 months using the same raw material from the same source that I'm relying on for Saudi, so that I don't have any tweaking or any change, so we can assure the quality in the first time. So I'm getting materials to Egypt, in majority of it at the moment, at the same cost I'm getting it for Saudi, from the same supplier. I'm hoping that this period will elapse soon, and then I can get really materials to Egypt at the cost of or the real competitive cost for supplying Egypt, as opposed to relying on the same Saudi cost that I'm getting material at today, which will hopefully give us some significant savings for producing in Egypt at a different cost. But this will happen eventually, as I told you, because product by product we'll have to move into getting locally certified, and then we'll have to wait for 12 to 18 months using the same supplier, so that we don't impact negatively the quality, and then they will allow us to move into supplying for this out of other suppliers, as opposed to the same Saudi supplier.
Thank you very much.
Sure.
Last question is from the line of Abdullah.
Dr. Farah.
Yes.
I have a question regarding the share. You mentioned previously Jamjoom Pharma occupying 4.8, the market share. Is this the Saudi share or the Gulf or the Middle East share?
5.8, you mean, not 4.8.
Yeah, 5.8.
Yeah, 5.8 is our share, our market share in the retail market. And just to refresh your memory, the retail market constitutes up to 70% of the total Saudi business. So that's only in Saudi.
Okay, thank you.
Sure.
Tariq, do you have a minute for another question, which is in the chat box?
Yeah. I have all the time.
Okay.
Don't worry.
Okay. So, so there are a couple of questions in the chat box, and that will be the last ones. So one is about the timing of the tender sale. So does it happen only in any particular quarter, like it happened this year in Q3, or it can happen anytime during the year? This is question number one. Second is about the long-term guidance on the gross profits and EBITDA. Are you willing to share guidance beyond 2026?
Right. Okay. So the first question, basically, just to remind you and refresh your memory about how the tender process happened in Saudi Arabia, which is our key contributor to the institution and tender business. Everywhere else, we still have some tender and institution business in places like Iraq or Gulf, but relatively small when you take it in the grand scheme of things compared to the one in Saudi. So let's focus on the one in Saudi. Saudi, the authority moderated by NOPCO issue a tender on every 2 years, basically. In late 23, beginning of 24, they will issue a tender whereby companies can quote, get their awardation, and then they supply for the remainder of 24, 25. And then they will come again in 26 and issue the following tender. Now, the supply happen regularly. It's not 1 month more than the other, or there is relatively very little seasonality in this. But it's a subject as well of us and our ability to really meet and stick to the requirements in terms of the timeline, because sometimes we don't. Like, for example, we get the tender awardation for certain products, and there is a significant increase in volume versus the previous tender, and they are requiring more in the earlier parts of the tender supply than the latter part. And we didn't make our plans based on this. So sometimes we supply less in some certain given months, and we catch up as we move on. So it's not really carved in stone, and we don't 100% always stick to the timing, because don't forget, tender, like in Saudi, for example, constitute only until the end of last year 15% of our total business. This year, I would think it will close somewhere south of this. Perhaps it will get in up to 17 or 10 or slightly more. Still, we have more than 80% of the business in the retail that we have to entertain. So this other business will always take a priority, especially that sometimes we know about the tender awardation later on in the year, and in order for us to catch up, it takes us time. So this is how it goes. But there is very little seasonality, if that's the aim of the question, into the tender business itself. But it's more about our ability to pitch in and try to meet the timelines based on our initial forecast and based on the previous volume. And sometimes we are spot on, and sometimes we lag behind a little bit because they give us quantities beyond our expectations, and we struggle to get the materials on time, so it takes us longer time to supply. So this is how the process works in a nutshell.
Yeah, and the second part, answer of the second part of the question about the guidance.
Guidance, as you can see, I mean, we share. I don't think, quite honestly, and that's not a credit for us, but on the contrary, it's more of us showing respect to you guys. We never, so since we went public, we never give you just an existing year guidance. We said we'll give you a plan that will carry us from 23 up to 26, because we manage our business almost in cycles of 3 years, give or take. One can argue it's short, so you can take it to 5. One can argue no, other companies give only 1 year on year or couple of years, but we decided that we'll handle it in cycles of 3 years. So we give up to 26, and as we come closer, so hopefully at the end of 25 or something, maybe we'll give you a longer term plan which will carry us forward from 26 up to 28 or 29. But at the moment, we just finished a year and a half of the initial plan, and we are committed to this kind of guidance on the screen up to 25, 26, which is 12-15% on the top line, and on the EBITDA front, 30-31.5%. We never give guidance on gross profit, because gross profit is not really going to help you guys to forecast the company, because we can do better on gross profits, but we do less on EBITDA and on earning on final earning. So I think what matters for you more is how we track on our EBITDA margin and how we track on our net profit margin. I think these are more important. That's why we keep on sharing this with you on regular basis.
Very helpful. So we have already exceeded 1 hour slot, but I see that the
I don't
hand
mind.
being raised by
This is
Sultan.
important, and we do it once per quarter.
Sure,
So
sure. So I'll allow
if
Sultan
there are
to
other pressing questions, I can entertain.
Sure. So this will be the last one. Sultan, please go ahead. Sultan, could you unmute yourself and go ahead? Seems there is some issue with Sultan's mic. Sultan, could you try again? Or you can post your question in the chat box. Dr. Tariq, it seems there is some issue with Sultan's mic. So either we wait for a minute or
We can wait for a minute, no worries.
Okay, sure. Sultan, we are still unable to hear you. You can use the chat box to post your question. Dr. Tariq, I'm not sure whether he's able to hear us.
Okay, so he can always, he can always
Yeah.
send it later to MBK, Mohammed bin Khalid, and then we
Sure.
can entertain it via email or via other ways of chat.
Sure. So if you have any closing remarks, you can share that, and with that, we'll end the call.
No, again, as always, I really appreciate the creative listening of all our investors that became partners by the time so far. Very pleased with our results so far, and still committed to continue to push very strong results as we move on up to end of 2026. And yeah, thank you as well for the attendance quarter on quarter, and I look forward to sharing with you our full year of 2024 sometime in January, inshallah. With this, thank you very much, and God bless all. Assalamu
Thank you, Dr. Tariq and the team, and also the participants for joining the call. Have a good day ahead.
Thank you.